What's up everybody, welcome back to Earn It, Save It, Invest It. In this video, I'm going to explain why you should be looking to buy Hims stock. It's crashed pretty significantly over the last month and a half. That was my biggest position in my portfolio. It's completely crashed. I think right now is actually a perfect time to buy. So I'm going to go over exactly why you should look into it. So yeah, if you can, please give a like and subscribe to, where is it? There it is. Please give a like and subscribe to my channel. And yeah, I'm going to quickly just go over what I think about Hims stock. This is my account right now. I'm going to try to take my account and do $100,000. But right now, Hims currently takes up 17% of my portfolio. I recently did sell 10 shares at $58. I had a feeling that it was going to crash, and it did exactly what I thought it was going to do. So I did sell. I had put in a little over $1,000, about $1,100 into Hims, and I sold for about $580. So I'm still in for about $500. But that being said, I got some capital. My initial capital investment off the table. So Hims right now is at 34.71. As you can see, let's go over Hims. The seasonality, typically in November it goes up, right? Typically it goes up in November, but it's not, right? It has not gone up in November at all. In fact, if I show you Hims, right? This, since November 1st, Hims has gone down. %. Hims has gone down 27% since November 1st, right? But yet it's saying that November is one of its most profitable months. Now we only have up since the end of 2019, basically since 2020, right? We have about 5 years of data. And so we don't have that much. We have about half of what most of, this goes 10 years back for most stocks. And so we don't have that much data, but the fact is November is usually an up month, and it actually went down. This whole year, when you look at each month, I mean, look, you're talking 54%, 20%, 34%, 12%, 70%, 12%, 32%, 36%, 34%, 20%, right? Like, these are big, big numbers each and every month. Now we're gonna put November down 27%, right? These are big, big numbers. I do think that Hims can come back with another possibly 20, 30% gain in December. Doesn't mean it's going to happen right away, but I think at the end of December we could be seeing some pretty big numbers showing up for December, right? In 2020, after it had a hard October, it went up 38%, right? After two back-to-back months in 2022, it went up 36%. So, after 4 months in 2023, one of them being 25% down, it went up 48%, right? So down 30% here, and it went up 25 and then 70%. So it just seems like once it's hit a few months, that's been pretty harsh. It kind of goes, 2021 was pretty harsh on it in general, 2022 as well a little bit, but I don't know. I just see, if this is going to be negative 25, 20, something like that, this is going to be a bigger, that's just my opinion. If we look at the revenue, right, the revenue estimates continue to go up. If you look at the revenues, and we'll go over the numbers right now, it's just continuing to go up. It's continuing to go up. Earnings per share, it's kind of been all over the place. They've made some acquisitions. They just announced a stock buyback. So they're going to be doing a bunch of stuff with their earnings per share. They did just become profitable too, so that's good, right? Profitability A minus. Let's see here, what do we got? I actually want to go over their financials really quick. So here we go. We have financials. And if you look at the revenues, right? The revenues have been going up. Come on. the revenues have been going up significantly, right? You're talking about 2018, 26 million, then 82 million, 142, right? Now we're talking in 2025, essentially, we're going $2.2 billion of revenue, right? Last year was 1.4. Before that, they weren't even at 1 billion. So the revenues are continuing to go up significantly. Now, operating income, this is really where your profit is, right? You have your gross profit, but at the end, you have your selling, your general and administrative expenses, your R&D, all these other stuff, right? That can take away so much of your profits. So essentially, this is your profit, right? Your operating income, or actually, sorry, your earnings from continuing operations, and then your net income to excluding, right? So you have $133 million in net income. Now look at, as you can see, they were losing money all the way up until last year. Now they're actually making a profit, which is absolutely amazing, right? You want to be investing in profitable companies. If we look at the balance sheet, they have cash and cash equivalents has continued to go up significantly, even when they have bought other companies and they've been making investments and stuff like that, right? So, let's look at total liabilities is 450, right? Total assets is 2.2 billion. So, hold on. Total liabilities is 1.6. So the equity is 581, right? So they have more, and when it comes to cash, they only have 345, whereas in their liabilities, they have a lot more, they have a lot less cash than they do in liabilities, but they're a growing, really high growth company, so that's okay. Their cash flow is actually okay, but the problem, they had one big problem, where is it? Right here. Where was it? Right here. Right? They had cash from investing. They've invested a lot of money in this last 12 months. And so when you look at this, the number looks so big because they've bought company, they bought Zava. They bought, they've put a lot of investments this last year. So, their CapEx has gone up so much, right? Cash acquisition. They've done a lot. So their cash flow definitely got hurt. Their margin, a lot of things got hurt from that, but that's again just to help integrate and make more growth for their company. So I find that perfectly fine. Let me see if I can do this. There we go. I don't know if that's any better. Now I do want to see their earnings right now. I just want to look at the earnings history. Here, we'll actually go back to this. If you look at the earnings history, right, the revenue year over year, they've had just tremendous year over year growth. Even if it's gone down, right, you're talking 83% compared to 104 is, down 20%, but that's still really significant growth. Then they went through a period, 2023, 2024, a little bit, where it wasn't as significant as it was, and then they started to grow again really fast. I remember when they had the Super Bowl ad and everything, right? Everything was going really good for them, Wegovy, all this stuff. And then it started flipping back around, right? And this is where the stock really started to hit a little bit of some turbulence. At the same time, Hims is a very volatile stock. It's very volatile. It's going to go up and down all over the place. It's still kind of new. It's only 5 years in, being a publicly traded company. So it's going to have a lot of ups and downs, and you have to understand that. But if you can catch it while it's going through its down, then, it's pretty good. It's called catching a falling knife, right? And technically, you don't really want to be catching a falling knife, but if you can catch it by the handle, that's great. So right now, they're kind of in this little period of, they just went from 110% revenue growth to now going to under 50%, right? Their earnings per share went from 20 cents down to 6 cents. Now, that's not a trend that's going to be continuing, right? That you can see the trend was going up and up and up, right? To become a profitable company. They've done a lot in this last few months and in this year of investing and buying companies and doing a lot. So it's like they still have a lot to do. The revenue, of course, we're talking, this is also revenue. Now, one thing they got, the Wegovy, they had their whole thing with the Novo Nordisk, that whole issue. So that really also kind of messed up their numbers. But if they just keep growing, they said they plan to have 6 billion by 2030. I mean, that's, 2.5 times what it's making right now per year. So I believe that Hims is going to be just fine in terms of how much money they make and their growth trajectory. Right here, revenue, again, 49% year over year. The net income, they actually had it's a tax. I can go down, right? But their net income was 16 million this quarter compared to 76 million last quarter. Like, what the heck? That's horrible. Well, the big reason was they had let me try to, if I can find it really quick. I'll say it was like a tax, a release of tax valuation allowance, right? So it was last year, that $76 million in net income, it included a $61 million tax benefit release to the release of a tax valuation allowance. So technically, even though, yes, it was a lot less than last year, that's because there was a one-off, right? So it wasn't that big. Really, it was about 15 million last year. So it went up a little bit. But the net income looks bad. When you have a number like that, it just looks bad for people, right? Up 53% on their adjusted EBITDA. Operating cash flow up 74%. Free cash flow, they don't have anything, 79 million. Subscribers up 21%. And monthly online revenue per average subscriber is up 19% year over year. Now, this is the total subscribers utilizing a personalized treatment plan. They definitely are pushing the personalized. That's where they're investing a lot of money in as well. So they're trying to get people into personalized health care where you're really doing stuff based on your own body and what you need yourself. Not a one-size-fits-all. They're expanding the accessibility and breadth in existing specialties. They reduced the prices of the GLP-1 treatment for up to 20%. So, they are doing that. And that's going to lower a little bit of it's not going to lower the revenues, but it could just, I think that what they're trying to do is just get more subscribers. They want more subscribers in. Once they get them on, they can make them pay more per month. And I think that's going to be just fine. They're launching new specialties that resonate with both new and existing customers, allowing subscribers to proactively manage their health with plans to broaden diagnostic capabilities and preventative solutions. So they want to do stuff that's not just, hey, you have a problem, let's take care of it. They're going to say, hey, you don't want to have this problem, let's take care of it before it actually happens, right? Again, that's definitely more medical than just subscribing a pill to somebody. Forging relationships across the healthcare ecosystem to become a curator, best-in-class solutions and services. Scaling our presence in international markets. So they did buy a company called Zava. It's a leading European digital health platform with over 1.3 million customers. Now, let me zoom in on this. With over 1.3 million customers. And so they just bought it in June 2025 with the deal officially closing in July 2025. So they're going to have access to a big part of Europe, right? Let me see. In the UK, Germany, France, and Ireland, right? So they're expanding into other parts of the world, which should help their numbers obviously a lot more. All right, strategic efforts to do more for customers are driving significant market expansion. So they're just trying to do more, right? New specialties, elevating the availability of precision care. So basically personalized health care. They're doing as much as they really can. How we're helping more customers succeed in weight loss. So they're scaling one of the largest personalized care footprints. This is where again you're able to like say, hey, this is who I am, this is what I weigh, this is what I do, this is what I eat, and all this stuff, and it kind of goes based on you rather than again one size fit all. They're let me go. We got testosterone, we got premenopause and menopause. Making proactive diagnostic testing the new standard. So they're trying to just find what's going on with a person and then how they can help them. They're really trying to become, in a way, if you think about it, they're almost trying to become your primary care physician, almost, right? You're going to start going to that, hey, like, not that you're sick and this and that, but you have all of these other things, like you have a primary care physician that says, hey, you have this kind of an issue or that, and then you're going to HIMSS. HIMSS is going to be a lot of like the second person you go to, right? You might say, hey, I need this, I have this issue, or hey, I have, this symptom, whatever, and then you go to a doctor and they say, oh yeah, this is kind of what your issue is. Then HIMSS is going to help you with that. HIMSS is also trying to be that person where you go and you actually take a test with HIMSS, and then they tell you, hey, this is what's wrong with you, and look, we got the solution for you. So they're kind of trying to be not a doctor's office or anything like that, but they are trying to be more of that, right? Diagnostic type of stuff. The revenues Q4 of this year, 605 to 625, and then is what they are expecting. And then for the whole year, 2.34 billion to 2.36 billion, so year-over-year growth of about 60% almost. And the EBITDA margin is about 13% this year, so it's a growth. I can go over, let's go over a little bit, the subscriber and revenue growth. Now, granted, the subscriber growth, so you can see it kind of stalled out right here. It literally completely stalled out right here, which again, when you're talking about a growth company, if you're stalling in subscriber and revenue growth, that's not good, right? They went down right here in the revenue growth per average subscriber. So this is not good. This is not what investors wanted to see. But sometimes you're going to hit a speed bump in this, and that's what's going to happen. I believe in HIMSS and the company and the the leadership. So they're just, I believe it's going to keep on pushing forward and pushing up. We can go over a little bit of this, right? The net income, again, it bounces back and forth, and it's continued to go down a little bit based on investments and all of that, but their adjusted EBITDA, obviously, as you can see, is continuing to grow. It's taken a hit this last year. They've done a lot of investments and a lot of other a lot of capital expenditures and investments. They finished a stock buyback, and then they approved another 250 million stock buyback over the next 3 years. So that's going to help the earnings per share. So I just believe in HIMSS. I do believe in HIMSS. I believe in the company. I believe in what they're doing. I believe in the numbers. I just don't see those numbers continuing to stall out or to go down. People want to have personalized healthcare. They want to be able to get it easy and very efficient, delivered to you. So I just think HIMSS is a good time. And one thing I actually really want to go over, actually I did not go over this yet, is the stock chart, right? When you just look at the chart, this is the year to date, and it's still up. It is still up 38%. It is still up 38% in terms of for the year. Now, if we look here, obviously it's gone down pretty significantly, 46% in the last 37 days, right? But when you look at this chart, it's continuing to go up and down, up and down, up and down, up and down. Now, one thing I have noticed a lot is that when it hits a peak and it drops down, it will drop below this line. You see this line? This line right here represents the last peak, right? So you have a peak and it drops down below the last peak, right? And then it bounces, flies through the previous, and then goes up, creates a new peak, drops down below this peak, and then it bounces up, right? Now this was an astonishing moonshot, right? and then it went down, and it kind of touched that line a little bit, right? It kind of touched that line, bounced up, right? Came back up again. And now we're here again, hitting this line, really dropping below this line. Something is telling me we're going to have to bounce. We're eventually going to hit this. Now we're talking $68. That's a big, we're talking 94%, right? We're 100% move basically. That's not going to happen as quickly as it did right here, but you also never know, right? I do believe that this company will be able to get back to this green line. Let's say here, let's give it 6 months, right? 6 months, it'll be back to that, and it'll be just fine. Doesn't mean it's going to go exactly in that, it's not going to go like that. It can go like this, and then, it can go like this, stuff like this. This is how the stock market is, right? You could easily do this, right? Like, it could do that. It could do that, right? And these swings are going to seem so dramatic. I mean, we're talking 23% swings, right? Here's a 15% swing. But it's just going to continue to go up. That's just my prediction. That's just what I think is going to happen. HIM stock seems like it's on in a good spot to buy, right? I mean, this thing it's gone down so bad. And then also, let's also look at this. I mean, look at this. Look at the MACD, right? Right. I mean, this thing it's as low as it's ever been, and obviously it bounced high up there. I mean, it's just you look at the waves, right? It's just going in waves, and I think right now we're at the bottom of this wave. It doesn't mean we're completely at the bottom, but I do believe this thing is going to push back forward. I do believe the market in general, because I mean, look, this was the market. This was in the last week, right? The whole last week. This is what the market's been. Hasn't been too good, obviously, right? And you look at something like the Qs, right? I was actually predicting that this market was going to drop earlier. This is what I'm now going to move that. But I was saying that the market's going to drop, and it did. It eventually did. I just thought it was going to happen earlier. I definitely thought it was going to happen earlier, but I'm still predicting a 12 or so % drop in the market. So this right here represents a 10% drop in the market right here, right? That's 10%. I still think we have some room to run down before we push up. I think this last week in Thanksgiving of November could actually be a hard week. I think we could finish off November bad and then just do a Santa Claus rally for most stocks, right? A stock like Adobe, let's look at something like Adobe, where mostly if you bought at any point during this year, you've lost money, right? If you bought, yes, at any point, you've now lost money no matter what, right? So it's going to be tax loss harvesting, where if you lost money on a stock, if you lost $1,000 on Adobe, but you made $1,000 on HIMS, and you sold, like for me, I made money on HIMS. I mean, it's in a retirement account, so I'm not going to get taxed right now. I'm not going to take anything out. But, let's just say you have a brokerage account, whatever. You profit, you got $1,000 in gains, but then you also have $1,000 in losses. You can go ahead and sell your lost stock, right? And use that against the gains that you made, so that way you don't have to pay taxes. So a lot of people will do that. So at the end of the year, come the end of November to maybe the big first half of December, people start just selling out of all those bad stocks that they had. So if you have something like an Adobe, something maybe like a Nike, other stocks that haven't done very well this year, they might continue to drop for the next few weeks. Then the last 2 weeks of December, people start taking vacations and things just kind of settle down, right? Now, it doesn't mean the market in fully is going to do what I just said. That's tax loss harvesting. The stocks that are already beaten down, they're going to probably continue to go down. Now, the other ones, like, it's actually interesting, right? Something like a Meta. Meta is actually down for the year, but it's not so down to where, let's look at percent year. It's down almost 2%. But people are not going to sell out of Meta just to take tax loss harvesting right now. They're not going to do that. So, just watch out for specific stocks for that. But I think the general market's going to have a hard time over the next week up until the end of November, and then kind of boost in December mostly. Some stocks like Adobe, I actually think could continue to go down, and I'm going to continue to buy them if they go down. So that's all I had to say. Please give a like and subscribe. Let's see if it pops up. Please give a like and subscribe if you're even watching this video still. I know it can be kind of a lot, trying to just do what I can, go through these stocks, go through the charts, and just kind of preach consistent investing. I'm putting $50 a week into this account. I'll actually show you the account really quick. All right, so my road to 100K. I'm not doing as well as I'd like to, because my account, HIMS and Celsius, these stocks have gone down. Now HIMS, the thing was, when I started this challenge, HIMS was already up so much. It was up significantly. I was already up 100% on the position. I knew at some point that this whole thing was going to come crashing down for me. At some point I was going to have a dip, and then it would come back up and dip, right? But I knew I started this challenge at a high point. So I already knew I'm kind of starting it at with a challenge, but it's long term, right? Long term. If over the next year, my numbers might not be looking as great. Over the next 2 years, maybe a little better. 3, 4, 5 years, now my numbers are going to be just fine. 10 years, I'm doing just fine, right? As long as I invest correctly. So, but I am putting in $50 a week. And I think that's done so much. I'm up on my portfolio, it was like 7-8%, because I've been putting in money, right? Now, if I took away all the investments I put in, all the $50 that I put in over the last 25 weeks, I would have been down 8%. So, and this is me, that's me being really down, right? All these stocks are going to go up eventually, and I still have money to be buying into this little dip that's happening. I now have money to be buying into it, so I feel good about it. But yeah, like I said, please give a like and subscribe. I really appreciate it. Thank you for watching, and never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.